Office of Tax Appeals. My name is Tommy Leung. I'm the lead judge for this afternoon's hearing. With me are Judges Lee and Lambert. Together, we will be equal participants in making the decision in this appeal. This appeal is being transcribed. Our reporter for today is Christina Rodriguez, and she has full authority to stop the hearing to clarify what is being said by anybody. To keep things running smoothly, I suggest that we all speak clearly at a normal pace, and please do not speak over each other. The best practice is to mute your mics when not being used. This hearing is being live streamed, so I caution anybody from referencing confidential information like addresses and social security numbers. We do have some, before we go on the record, we do have some preliminary matters to take care of. There were 3 additional exhibits presented by the Franchise Tax Board after our pre-hearing conference, exhibits E, F, and G. Mr. Garrett, have you received those exhibits?
I did, yes, Judge.
Any objections to them?
No objection.
Okay, so when we go on the record, I'll admit all the exhibits. There's also the issue of the audit file. Mr. Garrett, did you receive that?
Yes, we received it all set. We have no objection with that either.
Very good. Without any further ado, we will go on the record. Ms. Rodriguez in 3, 2, 1. This is the appeal of Fulzele and Satarkar. The docket number is 2407-16600. Today's dated February 18th. It's approximately 1:35 in the afternoon. Would the parties please introduce themselves, starting with the appellants?
William Garrod, representative for the appellants.
Thank you. For the Franchise Tax Board?
Lawrence Shao for the Franchise Tax Board.
Good afternoon, Judge Ellen Swain for the Franchise Tax Board.
Welcome to all. Before we get started, the exhibits were submitted to OTA prior to today's hearing. The appellants submitted exhibits 1 and 2 without objection from the Franchise Tax Board. They will be admitted into the record. Franchise Tax Board submitted exhibits A through G as in George without objection, and they too will be admitted into the record. We have allotted a total of 75 minutes for today's hearing, 30 for the appellants and 25 for the Franchise Tax Board, and the appellants get 5 minutes at the end for rebuttal should they choose to decide to use those extra 5 minutes. Any questions, Mr. Garrett?
No questions, Judge.
Mr. Shao?
No questions.
Okay, Mr. Garrett, you can start your pleasure.
Thank you. So for the 2020 tax year, the taxpayer Snehal Fulzele, who is at issue here, and his wife Rushali Satarkar, appeal the notice of action, which we included as Exhibit 1, which proposed additional tax and interest totaling $623,093, which included $541,517 of tax, plus additional interest that was computed through May 30, 2024. To summarize, the taxpayers were California residents through 2018, which is stipulated for 2018, and became California non-residents in 2019. And it's stipulated that they were California non-residents for the 2020 tax year, which it is issue here. The notice of action erroneously proposes adjustments attributable to purported by the FTB installment sale from 2018 when the taxpayers were California residents, which the FTB asserts should be California source income in 2020. This earnout is properly characterized as unvested property subject to a substantial risk of foreclosure, which was vested and properly recognized in 2020 when the taxpayers were Texas residents and California non-residents. As such, that income from the earnout payment, which was recognized in 2020, is not California source income. And so the primary issue here is fundamentally whether this earnout payment constituted an installment sale as purported by the FTB, or was unvested property subject to a substantial risk of forfeiture, which vested and the risk of forfeiture lapsed in 2020 when it was recognized by the taxpayers as non-residents. In the alternative that is determined to be an installment sale, which we believe it should not, there's a secondary issue of whether that installment sale would have acquired a situs in Texas rather than California, and as such be non-California source income. So for a background of the facts, from 2014 to 2018, the taxpayers were California residents who filed joint California resident returns. Mr. Fulzele co-founded and was the CEO of a company called Cloud Lending. It had a prior name, MFIFLEX Incorporated, but we'll refer to it throughout as Cloud Lending. In October 16th, 2018, which we'll call the merger date, Cloud Lending was acquired by Q2 Software for $105 million pursuant to a merger agreement. That merger agreement, which we'll refer to as the agreement, we submitted as Exhibit 2. The acquirer, Q2, was headquartered in Austin, Texas, and as part of the transaction, Mr. Fulzele was required to work at that headquarters in Texas to continue to manage Cloud Lending. He was required to move to Austin and manage Cloud Lending as the general manager through 2020. Under the terms of that transaction, Q2 was required to deposit 10% of the purchase price, $10,500,000, in an escrow fund that was not subject to the claims of any creditors, and that's referenced in I'll refer to the merger agreement Exhibit 2 as the agreement section 2.10. Under the terms of that agreement, all of the equity holders sold their shares in the pre-existing entity Cloud Lending in exchange for cash, which is not at issue here, and an earnout payment, which is at issue here, which would result in payments only in the event that Cloud Lending reached certain targets, which we'll discuss later. And that's provided in the agreement sections 2.6 and 2.14. So qualification for these earnout payments was based on Cloud Lending achieving what they called an ARR run rate, which essentially was a certain level of recurring contractual subscriptions and portfolio fee invoices on two certain measurement dates of June 30, 2019 and March 31st, 2020. If those measurements were not met, then there was no earnout payment at all due, and the taxpayer would receive nothing. There was a sliding scale whereby if certain targets were met, there were payments to the overall recipients of the earnout property, ranging from 20 to 40 million. Mr. Fulzele's was a smaller portion of that, and capped at the 40 million. And so if these targets were met, as of these measurement dates of June 30, 19 and March 31st, 2020, which had some procedures for the actual payout, which I'll discuss later, then Q2 would be required to make those earnout payments. And that's provided again in agreement section 2.14. And these conditions were the same for payment of the earnout were the same for all equity holders. So in 2018, at the time of the transaction, Mr. Fulzele recognized approximately a gain of approximately 10.7 or 8 million on the sale of his stock in Cloud Lending for cash. That's not at issue here. What at issue is here is, and he recognized that and paid California tax on it as a resident. What's at issue here is solely the earnout. So from the transaction date on October 16th, 2018, he took about 2 months off, and none of these facts are in dispute. I don't think we've had any factual disputes in either of the briefs. He traveled to Dubai on vacation with his family for approximately 2 months, and then began employment with Q2 in Austin, Texas in December 2018. And during that period, beginning in December 18, he traveled significantly to Texas to work on the integration of Cloud Lending with Q2. He began his employment there in mid-December 2018, And then on February 19th, 2019, so approximately 2 months later, the taxpayers and their children moved to Texas and established Texas domicile February 19th, 2019. And he continued to perform those services for Q2 and cloud lending entirely from Texas from the date of that move until he left the company on December 15th, 2020. So in 2020, cloud lending achieved certain ARR run rate targets, and all of the equity holders, including Mr. Fulzele, became entitled to the earnout payments. So in 2020, he received a total of $4,334,568 of payments, which included $1,345,586 on May 1st, 2020, based on the first ARR run measurement date of June 30, 2019, and just under $3 million, $2,988,982 on July 2nd, 2020, based on the ARR measurement date of March 31st, 2020. So beginning February 19th, 2019, it's undisputed that they were California non-residents. This is stipulated for 2020, which is the only tax year at issue here. Accordingly, they did not have source income and did not file a California return. The FTB's proposed adjustment is based on a characterization of this earnout as an installment sale under IRC 453. The FTB contends that because Mr. Fulzele was a California resident in 2018, and it characterizes this as an installment sale, we believe incorrectly, that the subsequent payments under the earnout were California's source income to Mr. Fulzele as a non-resident in 2020. For the reasons I'll go through here shortly, the earnout's properly characterized as unvested property subject to a substantial risk of foreclosure, which was properly vested and recognized in income in 2020 when the taxpayers were California non-residents, and accordingly, because that intangible property vested and was recognized in 2020 was not California source income to any extent. And I think it's helpful here, we included it in the briefs to go through an overview of the kind of the federal tax requirements, and I think IRC Section 83 provides some significant guidance on what it means to have a substantial risk of forfeiture and when property is recognized. And we've referenced in the brief, but I'll refer the OTA to IRS Revenue Ruling 2007-49, which was a merger sale transaction where an acquiring corporation acquired half of an employee's vested stock in an acquired corporation for cash, similar to our case, and the other half for unvested stock in the acquiring corporation. So the employee had vested stock in the original corporation. The acquiring corporation, similar to ours, paid cash for some of that stock and gave unvested stock in the new company. The IRS determined that that unvested stock was taxable at the time when it became substantially vested and was no longer subject to a substantial risk of forfeiture, which unquestionably recognizes here that it's possible to impose vesting restrictions on property like the earnout at the time of the merger that could run for some period of time after that. In addition to California's conformance with Section 83, California also conforms with IRC 409A, which has an addition to tax for certain deferred compensation. The federal addition is 20% and the California is 5%, but California conforms in all other substantial respects. And the overarching principle of 409A is that income is recognized when the taxpayer, when there's a right to receive the income without a substantial risk of forfeiture. And if the certain requirements are not satisfied, which one in part is having all equity holders have the same terms, then there's this addition to tax for both California and federal tax purposes. And under the regulations to 409A, 1.409A-3, sub 154 cap A, the time period of the deferral is treated at the beginning on the date when the property became no longer subject to a substantial risk of forfeiture. And so the important point here to be made is that when there are persons who previously sold vested stock at the time of merger, and those vesting restrictions delay recognition of that income until the date of vesting, that's when the income is recognized, is when those vesting restrictions lapse. The FTB has asserted that this is an installment sale under IRC 453. Under IRC 453, an installment sale is a disposition of property where there's at least one payment received after the close of the taxable year in which the disposition occurs. That's 453B1. And under an installment sale, the income is recognized in the proportion of the gross profit bears to the amount received in that year to the total contract price, which will be important, as I'll discuss in a minute. So for our California non-resident sourcing requirements, California conforms to the Internal Revenue Code for these tax years as of January 1st, 2015. And for non-residents, non-residents are subject to California tax to the extent of California source income. The California conformity includes conformity with the timing for taxation of stock and other equity compensation, and those vesting restrictions and the lapse for the time of recognition are respected. So to the extent an equity holder was not working in California during the vesting period, California generally does not impose California income tax on that equity. Now, for a non-resident's income from intangible property, such as shares of stock in a corporation, it's taxable to a non-resident as California source income only if that intangible property has acquired a situs in California, which Section 17952C of the regulations provides. There's a situs in California if it's localized, or in another state, if it's localized in connection with a business, trade, or profession in the state, so that its substantial use and value attached to and become an asset of the business, trade, or profession in the state. And so for installment sales under Section California Revenue and Taxation Code 17952D, I apologize, that's the regulation. Regulation 17952D provides the example that if a California resident sells intangible property under the installment method and subsequently becomes a non-resident, any gain attributable to those installment payments is California source income, absent a business situs exception, which goes to the second point here of if we're in the alternative that we're determined to be installment sale, this situs provision becomes important. So what these requirements do not address is where there's new vesting restrictions imposed on property after the effective date of the sale, as we have here. And I'll refer the OTA to the case which we cited in the brief of 2009 Metropolis Family Trust, which dealt with the situsing, the business situs of intangible property, goodwill in that case, and provided that where the taxpayer extends his activities with respect to the intangibles to avail himself of the protection and benefit of the laws of a state, such as to bring his person or property within the reach of the tax gatherer there, the reason for a single place of taxation no longer exists. And so a taxpayer domiciled in one state carrying business on another is subject to tax based on the value of the intangibles used there. So here, as I'd mentioned, I think for California purposes, the guidance that we have related to Section 83 property is under Publication 1004, which provides for certain types of compensation, such as restricted stock, are allocated based on the California, for a non-resident, based on the California workdays from the grant date to the vest date. So under the example provided, if a California resident purchased stock subject to a substantial risk of forfeiture for a 4-year period and subsequently became a California non-resident, the gain on that restricted stock would be allocated based on California workdays to total workdays within that grant to vest period. And so based on those federal and California requirements and the California conformity with those federal requirements, this earnout is not California source income to any extent because it was properly included in income when it became fixed and determinable and vested in 2020. So under Section 2.1 of the agreement, of the merger agreement, The earnout was funded with escrow funds that Q2 deposited, and all equity holders were treated the same. And so under 409A, which they comported with, this was not deferred compensation until there was a lift of the substantial risk of forfeiture, which happened at the time Cloud Lending achieved the ARR run rate targets on those two measurement dates. Accordingly, the earnout was properly vested. These two payments were properly vested and includable in income by Mr. Fulzele in 2020 at the date of the earnout payments or at the earliest 15 days prior to each, pursuant to 2.14 of the agreement, when they became no longer subject to a substantial risk of forfeiture. And again, I'll reference Revenue Ruling 2007-49. The FTB, as I'd mentioned, has asserted this as an installment payment. The FTB's brief notably goes off the assumption that this was an installment payment without any analysis whatsoever of IRC 453 for its determination that it is an installment payment, which we disagree with. They do note that Section 510 of the agreement refers to a deferred contingent purchase price eligible, is the language used for installment treatment under 453. However, this isn't like a normal installment agreement because this earnout was subject to a substantial risk of forfeiture if these targets were not met. If Cloud Lending didn't meet these certain targets, then there could have been no payment whatsoever or widely varying amounts of payments. And importantly, under an installment sale, that allocation of any gain based on the proportion of the payment received to the total contract price would be impossible here, where there's no way to know what the total payment would be for either of the earnout payments. And so I think there are a couple other points related to the FTB's argument on the installment treatment. First, the FTB, notably, the agreement is somewhat imprecise in referring to the transaction being eligible for installment treatment. They also refer to retention consideration in the agreement as merger consideration rather than compensation, which is what it should actually be referred to as. And I think the point is that for federal purposes, ultimately the meaning of that provision in the agreement is the same, that the earnout is deferred and recognized at the time of the earnout payments, if any. And in addition, it simply states that they're eligible for installment treatment, and the terms of that agreement can't modify the correct characterization here, which is that it's unvested property subject to a substantial risk of forfeiture in 2018 and was properly recognized in 2020 when those earnouts were vested. And so again, I'll note that the FTB's brief has no support or analysis whatsoever for its determination that this is an IRC 453 installment sale. And unlike a typical installment sale, these earnout payments were not fixed and determinable at the time of the merger and were completely subject to risk of forfeiture if those ARR run rates were not achieved. And so depending on the company's performance, Mr. Fulzele could have received absolutely no earnout payments or widely varying amounts somewhere between the minimum and the maximum depending on how Cloud Lending performed. Further, his management activities, he was resident of Texas. His management activities were based in Texas. For Q2, a Texas headquartered and based company measured based on the Texas operation of this Texas headquartered company. And so I'd also point the OTA to the FTB's opening brief, which incorrectly states, quote, the appellants sold their stock, when the appellants sold their stock, they were no longer owners and there was nothing remaining to vest, end quote. And as previously provided, that's just incorrect. This earnout was entirely contingent on achieving these run rate targets, and there was no guarantee whatsoever that Mr. Fulzele would actually receive an earnout payment, or if he did, what the amount of those earnout payments would be. And so these payments were clearly unvested and subject to a substantial risk of foreclosure, contrary to the FTB's brief. And I think this incorrect factual characterization of them as vested determined payments leads to their incorrect conclusion that this is an installment sale under 453. I'd also highlight that the FTB brief references Bracamonte, which is, that case is wholly misplaced here. It's inapplicable because it's all based on the assumption that that was an installment sale. Whether the arrangement there in between the taxpayer's change of residency and the treatment of that installment sale, there wasn't an issue in that case of whether this was actually an installment sale. And so here, again, this earnout was entirely contingent on Cloud Lending achieving these AR run rate targets, which happened in 2020 when Mr. Fulzele was a non-resident. And so again, as a non-resident at the time this was properly vested and recognized, none of this is California source income to the taxpayers as non-residents. To the extent that that the OTA determines that there is any California source income, then it's still required to be allocated based on the portion attributable to California. And based on the FTB guidance available, while we believe that none of this gain should be allocable to California, based on publication 1004, which interprets regulation 17951-5, the appropriate allocation would be based on the portion of Mr. Fulzele's work in California from the period of grant to the period of vest. I've given an examples with the timing of that in the brief on page 10 of our opening brief. But to summarize, for the first earnout payment received in May 2020 or determined 15 days before that under the agreement, the grant to vest period would be October 16th, 2018 until late April 2020, which is approximately 18 months. And during that, he worked approximately 1 month in California from mid-December 2019 until February 18, 2019, so 1/18 of that $1,345,586, or approximately $74,755 would be California source income, even under an allocation method which we believe is incorrect. For the second earnout payment of $2,988,982, which vested in July 2020, or 15 days before, the period of grant to vest would be October 16th, 2018 until late June 2020, so approximately 20 months. And during that period, he again worked approximately 1 month out of that 20 months in California, which would result in 1/20th of that amount, even under the FTB's theory being attributable to California, which would be $149,449 of California source income. And so again, while the appropriate characterization is that the entire gain is not California source income because it was vested and recognized in 2020, even in this alternative that some sort of allocation is necessary, it would be a total of approximately $224,204 based on that 1 month work during each of those grant to vest periods. And so lastly, in the alternative that the OTA determines that the FTB's characterization as an installment sale should be upheld, which we believe it should not, this earnout was intangible property that had a situs in Texas. Mr. Fulzele was required to work for Q2 in Texas. He was a Texas resident. All of his management activities were performed in Texas and were really driving and integral to Cloud Lending achieving those run rate targets and thus the earnout payments. And accordingly, that earnout, which was property based on this Texas-based company achieving these certain targets, acquired a business situs in California. And consistent with Metropoulos, even in the alternative that this is an installment sale, the earnout acquired a business situs in Texas, and again is not California source income. So in sum, just to recap, this was unvested property subject to a substantial risk of foreclosure in 2018 and was vested in 2020. Accordingly, since the taxpayers were California non-residents in 2020, this was not California source income. And even in the alternative that there's some allocation is necessary, it should be based on the 1/18th or 1/20th allocation ratio for his time in California during that period. And again, in the alternative that this is determined to be an installment sale, which the taxpayer believes it should not, that intangible property acquired a Texas situs, and again is not California source income. That's all we have.
Thank you, Mr. Garrett. I'll go to my co-panelist. Judge Lee, any questions for the appellant?
Yeah, question. I believe you stated that Mr. Fulzele was required to work at Q2's headquarters in Texas. Is there anything you could point out in our record that would prove that statement?
The employment offer and employment agreement do not specifically provide that, but Q2 is headquartered in Austin, and he was required to go there as the general manager of the company, leading the management of the company. He was the co-founder and CEO of the acquired company, and so that was the arrangement in their negotiations. It's not provided in the offer letter, but he did actually move he and his family to Texas to work there on February 19th, 2019, and that's undisputed.
Thank you. Another question. Say hypothetically he didn't work for Q2 in Texas, would he still be entitled to the earnout?
If he would, yes, if they achieve the run rate targets. I think without his participation, it's near impossible that the company would have achieved those targets. He was continuing to run the company similar to the capacity they did it before the acquisition, but his residence in Texas, assuming that he could do a good job and drive the company to meet those targets, wasn't a condition of receiving the earnout.
Thank you.
Does that answer the question?
It does. No further questions at this time. Thank you.
Judge Lambert?
I have no questions at this time. Thanks.
I will hold my questions. I will have Franchise Tax Board make their presentation first. Mr. Zhao, 25 minutes.
Thank you. My name's Lawrence, and together with Ellen Swain, we represent the Franchise Tax Board. So appellant has already stated the general facts and the main issue, which is consistent with what we have. We pretty much agree with all these things. So today I will present two main points. First, I'll demonstrate that the correct legal characterization of the earnout payment of approximately $4.3 million is proceeds from an installment sale of stock and not compensation for services. Second, I will show that under California law, the characterization of this income was fixed to California in 2018. So just repeating the background again, Mr. Fulzele, the appellant, he was a founder of Cloud Lending, Inc. The core transaction here is the 2018 acquisition of Cloud Lending, Inc. by Q2 Software, which is governed by the merger agreement. In 2018, Mr. Fulzele sold his entire stake, which is a zero-basis founder stock, as part of this merger agreement. It is undisputed that the appellants were California residents in 2018, the year the stock sale occurred, and appellants subsequently became non-residents of California after the sale. As part of this merger, Mr. Fulzele received an initial payment of over $10 million in 2018 for the stock, and he correctly reported that on his 2018 California resident income tax return. The merger agreement also created the possibility for future contingent earnout payments, which is the payments I issue in this appeal for 2020. So crucially, after the stock sale, after October 16th, 2018, Mr. Fulzele took approximately 2 months off, traveling to Dubai on vacation with his family, and then he began employment with Q2 in Austin, Texas, in December of 2018. This shows a clean and clear break between the stock sale and the start of his subsequent employment with Q2 Software. Mr. Fulzele received the earnout payments in 2020. The paying agent, JP Morgan Chase Bank, issued 2 Form 1099-Bs to appellants in 2020 for a total of approximately $4.3 million in these earnout payments, which is the amount I issue here. The appellants did not file a California income tax return for the 2020 tax year. However, appellants' federal tax return transcript shows that appellants received and reported the full earnout payments in the amount of about $4.3 million for federal purposes as long-term capital gains. So this earnout is payment for the sale of stocks in 2018, and it's not compensation for work performed. FTB's assessment of this income as California source income is a direct application of law under California Code of Regulations, Section 17952D. This income is directly attributable to the disposition of stock that occurred in 2018 when appellants were California residents. Appellants are trying to classify this earn-out payment as invested compensation to apply Internal Revenue Code Section 83. But the determining issue here is that the stock they sold resulted in capital gains, and it's not payment for work performed. As was clarified earlier, the work that was performed in 2019 and 2020 was not a condition to receive the compensation from the earn-out payments. So this founder stock is separate from compensation. The earn-out payments originated from the sale of appellant's zero-basis founder stock. It's not from employment in relation to the performance of services. And IRC sections 83 and 409A do not apply here because those provisions are specifically based on compensation given in exchange for the performance of services. The capital gains income Mr. Fulzele received in 2020 was payment for the sale of his stock, which occurred in 2018, and it was completely separate from his employment agreement with Q2 Software. The record establishes that Mr. Fulzele was paid for his services through a separate employment agreement with Q2 Software, and he began that employment after a 2-month break in Dubai following the stock sale. So the earn-out payment was not necessary for, and it wasn't intended to be, compensation for services relating to his employment agreement. Furthermore, Mr. Fulzele's contract with Q2 had a separate retention provision under Section 7 for severance, confirming that the earn-out payment was not tied to employment. This provision established a distinct negotiated benefit that the parties themselves agreed to in the merger agreement, and to treat this as a deferred contingent purchase price installment sale under Section 453 for tax purposes. Furthermore, the statutory definition of an installment sale under IRC Section 453B1 is disposition of property where at least one payment is to be received after the close of the taxable year which the disposition occurs. The disposition of property in this case took place in 2018, and the payments were received in 2020, 2 years subsequent to the tax year of disposition. Consequently, the payments appellants received in 2020 fall directly under the definition of an installment sale under IRC Section 453, which is the precise provision referenced to in the governing merger agreement. This income is sourced to the state of California. The sourcing of this income is governed by California Code of Regulations, Title 18, Section 17952. This regulation provides a clear, objective standard that the source of gain from the sale of intangible personal property, such as corporate stock, is determined at the time the sale occurs. Section 17952D reads, the source of gains and losses from the sale or other disposition of intangible personal property is determined at the time of the sale or disposition of that property. For example, if a California resident sells intangible personal property, such as stocks, under the installment method and subsequently becomes a non-resident, any later recognized gain attributable to any installment payment received relating to that sale will be sourced to California, absent a business status exception. The facts of this case fits directly within this regulation's framework. The sale happened while taxpayers were living in California. Mr. Fulzele sold out his stock to Q2 Software in 2018 when he and his wife were both California residents. The source is fixed at the time of sale under California Code of Regulations, Section 17952D. The structure of his continued service is completely separate from the contingent purchase price defined in the merger agreement. The presence of a dedicated compensation and retention package in the employment contract demonstrates that the earn-out payment was, by the party's own design, payment for the sale of stocks and not compensation for future services. In addition, there's also no risk of statutory risk of forfeiture, as was argued. Appellant's argument that the installment payment faced a substantial risk of forfeiture because the amount could have been zero is unconvincing. This was a straightforward business risk dependent on the acquired company's financial performance and its achievement of ARR run rate targets. This risk does not meet the statutory definition of a substantial risk of forfeiture. Under Treasury Regulation, Section 1.83-3, a substantial risk of forfeiture exists only if rights in transfer property are conditioned directly or indirectly upon the future performance or non-performance of substantial services by any person, or upon a substantial possibility of future forfeiture relating to a purpose of the transfer. This is also confirmed by the appeal of the bill 2020-OTA-198P, which cites IRC section 83A1 and 83C1. Gross income is recognized when property rights are transferable or not subject to a substantial risk of forfeiture. A substantial risk of forfeiture specifically exists where the property rights are conditioned upon future performance of substantial services by any individual. The ARR run rate targets in the merger agreement are purely a financial metric for the company itself. It's not a condition related to the retention or the performance of substantial services. Furthermore, the amount of appellant's initial negotiated stock sale payment in 2018 of over $10 million compared to the 2020 payments of about $4 million undermines the claim that the arrangement constituted a substantial risk of forfeiture tied to that service. Finally, contingent payments are covered by installment sale rules. Appellant's assertion that the earn-out payments do not qualify as installment sales due to the amount being entirely contingent is without merit. This argument is directly contradicted by Internal Revenue Code section 453F8, which explicitly addresses contingent payments within the installment sale framework. This section specifically includes that the fair market value of any payments which are contingent as to amount, as fall under installment sales. The contingency is used to determine the transaction's value, and is not a condition precedent for the sale's completion or the payment of vesting. Critically, the parties the appellant's change of residence occurred in 2019, followed by a receipt of payments in 2020. I'm sorry. Followed by the receipt of payments in 2020. The regulation is explicit that if a California resident sells intangible property using the installment method and later becomes a non-resident, any gain recognized from later installment payments remains sourced to California. Of course. So the source of the income was locked to California in 2018 when the sale was completed, and the fact that these payments were contingent does not change the source. It just means that purchase price was paid in different stages. Appellants failed to prove the intangible asset acquired legal business status in Texas, and their claim that the asset gained a Texas business status solely because of their employment in Texas contradicts governing legal principles. The appellants bear the burden of proof, which they have not met. In the presidential opinion, the appeal of Chrisman, 73-SBE-069, dictates that mere employment or job duties within a state do not establish business status for an intangible asset. As the taxpayer's claim relies exclusively on employment, that failed to satisfy this burden. So in conclusion, the available evidence demonstrates that the earn-out payments must be characterized as installment payments for stock sold in 2018, not compensation for services. This is substantiated by, first, the merger agreement, explicitly defining the transaction as an installment sale under IRC section 453. Two, appellants reporting the income from the installment sale on their federal tax return as long-term capital gains. And three, the fact that Mr. Fulzele had a separate employment agreement with Q2, which provided a distinct compensation package, retention provision, and termination clause. Consequently, the income is sourced to California under the clear and objective standard of California Code of Regulations, Title 18, Section 17952D. The source of gain from the disposition of intangible personal property is determined at the time of the sale. Because the disposition occurred in 2018 while appellants were California residents, the source is fixed to California. The subsequent change in residency and work are not relevant to determining the sourcing of this income. Therefore, I respectfully request the panel to sustain FTB's action in its entirety. I'd be happy to take any questions. Thank you.
Thank you, Mr. Shao. Judge Lambert, any questions for franchise?
I have no questions, thanks.
Okay, thank you. Judge Lee?
Yeah, I believe you stated that the facts are not in dispute in this case. I just want to confirm that's what you said.
Yes, the facts are not in dispute for, yeah, the procedure facts are not.
Judge, we do dispute the facts about the installment payment. Obviously, we're not in agreement. I think that's our central contention. I think that Mr. Zhao is describing, the facts that led up to the time of the sale and the time of changing residency and sourcing, because I think that that is obviously an issue that can be very, very contentious as to when someone ceases being a resident. In this case, we, both parties agree on the timing of those things happening, but that's when we depart in terms of our factual agreement. Thank you for the clarification.
Thank you. Another question. FTB submitted Exhibit E. Is there a particular page or line item number that you want us to look at?
Could I have a
I just
minute,
wanted
please?
to clarify why FTB submitted that particular exhibit.
Absolutely.
Judge Lee, that would be the federal transcript, correct?
Yes,
Mhm.
the transcript.
Judge, in Exhibit E, we see the compensation. When you look first, I think the return transcripts aren't the easiest things to read, but when you first look on the amount of income, which is on page 1, approximately 3/4 down the page, under the header, the bold-faced header of income, it says wages, salaries, tips, et cetera. That's $1.468 million, which tracks with what his wages were and the services that he provided during the tax year. But when you switch to page 9 and you see Schedule D, capital gains and losses, it starts at the bottom of the page. You see long-term capital gain and losses, which then begins on page 7, which totals at long-term capital gain reported of $4.334 million, which is the combined amount of those installment payments. And that was what we were hoping to show.
Thank you. No further questions.
Thank you, Judge Lee. Mr. Shah, one quick question at this point. You cited to a SBE decision in 2020. What is the exact citation, 2020 OTA-183 or something like that? What was that?
The bill or the SBE?
The OTA decision that you cited early
Yes.
on.
So that would be the appeal of the bill. 2020-OTA-198P.
198P. Thank you. Mr. Garrett, 5 minutes for rebuttal.
Sure, thank you. I guess first, I would just like to, I appreciate that the FTB agrees that these payments were contingent. I think I would like to clarify that we're not asserting that this was in exchange for services. This was not. This was an exchange of vested stock in the predecessor company for an unvested earn-out payment, which is property, an unvested earn-out payment to be paid by the acquiring company. So we're not asserting this was an exchange for services. We were referencing Section 83 and 409A, which have substantial interpretation of what it means to have a substantial risk of forfeiture and the timing for recognition of income. And so the really salient point here is that that income is recognized when that risk of forfeiture lapsed, when it became fixed and determinable in 2020. But we're, just to clarify, are not asserting that this was compensation for services. This was properly capital gain from property when that earn-out was paid in 2020. I do want to reiterate that obviously I don't understand how the FTB asserts that there was no risk of forfeiture and that those ARR run rate measurement goals were not a condition when, if they weren't met, the taxpayer would have received absolutely nothing. And this is the first instance. And FTB's brief was just based on the assumption that there was an installment sale. There was absolutely no analysis whatsoever for its position that this was an installment sale. And similarly, their brief didn't respond and I think we had interpreted it as not disputing that there was a business situs in Texas. That was addressed in our first brief, and they was completely absent from the FTB's opening brief. And so, I just reiterate that we disagree with the FTB on those points, and to the extent that the OTA finds those persuasive, we'd respectfully request the opportunity to submit, additional briefing on those points. If the FTB agrees that it's not necessary because, then I apologize. If the OTA agrees that this is not necessary because it's properly characterized as recognized in 2020, then obviously that's not necessary. And I would also just point out that for those provisions with contingencies in 453 are due to differences in an amount that have to be clarified, not the sort of potential payment where it's completely up in the air of whether, if, or the amount that will be received as we have here. So again, I'd just like to summarize that this was properly unvested property subject to a substantial risk of forfeiture. The FTB has agreed that it's contingent, and accordingly, it was properly recognized in 2020 and was not an installment agreement. And then in the alternative, that there is some California source income required, we believe it's required to be allocated based on those, the grant to vest period is provided in our brief based on those dates, and or that this property has acquired a Texas situs consistent with Metropolis.
Thank you, Mr. Garat. Final round of questioning for Judge Ali.
No further questions. Thank you both for your presentation today.
Okay. Judge Lambert.
I have no questions. Thanks.
I've got a few questions. The question is where to start. For the Franchise Tax Board, you mentioned there are provisions in IRC 453 regarding contingencies. Isn't that more with respect to how to value the installment agreement, whether you value it, fair market value at time of sale versus some later value when the final payment is made versus some other way of measuring the amount of consideration? Or is that more of a just saying that even you have a contingency, it is still nevertheless a installment agreement or installment payment?
Judge, if I may, the payments themselves, the fact that he's going to have future payments was contemplated in the merger agreement. And specifically under Exhibit E, it says, in the option termination agreement, it says, part of your consideration for the sale of your vested options are future payments. What is contingent is what the amount that will be calculated at the time. And that creates the installment sale. And the fact that, yes, you're going to get a payment, but we're going to base that on the metrics of what the company's performance is in that year, sets the actual amount. It's a calculation, which in our position is that when you read Section 8B, which you were just quoting, of 453 to say, okay, when we have this situation, we're contingent as to the amount. So that does not forestall the installment payment treatment under these circumstances.
So for purposes of this particular appeal, under the contingency provisions of 453, FDB is going to accept wherever amounts get paid out to the taxpayer in the year of payment. That would be the value.
In the year of payment of the 2018 initial payment or of the 2020 subsequent?
2020, in
Oh,
other
the
words.
2020. Yes,
right.
so that amount would be the amount that's taxable. I'm not sure what you're asking me. Could you try again, Judge?
Well,
I'm a little turned around.
I'm trying to figure out if the contingency provisions in 453F, as in Frank, are determining that in situations like this, where there is a contingency, where the taxpayer gets a payout in the future, which is not determinable at the year of sale, where that definition is to basically say, no matter what, it is still an installment agreement subject to the installment sale rules, or whether that subsection F is just a measure of what the amount of income is going to be.
Well, it's, they are still subject to the installment rules. And then the amount, the contingent, they're allowed to have the contingent amount be treated as the second portion of that installment sale. I mean, under the under IRS publication 537, it says a contingent payment sale is one in which the total selling price can't be determined by the end of the tax year of sale. This happens, for example, if you sell your business and the selling price includes a percentage of its profit in future years. If the selling price can't be determined by the end of the tax year in which the sale or other disposition occurs, you must use different rules to figure the contract price and the gross profit percentage than those that you use for an installment with a fixed selling price. And so we're able to use the installment rules under these circumstances.
And are there any other cases that you can refer us to that states that situations like this, that the entire transaction is still treated as an installment sale, other than just signed to 453?
Yeah, I mean, we're certainly happy to provide additional briefing if that would be helpful.
Okay. And of course, if the situations were reversed and Mr. Fulzele was originally a Texas resident and sold his company and then moved into California, you will of course agree that those earn-out payments 2 or 3 years down the road would not be California sourced.
You know, Judge, at this point, that's not really the facts of our case. So I want to draw back to what the facts of our case are, mostly because I've learned over time not to do sourcing in my head or OSTC in my head. So I think what's really important here is that the regulation 17952D was promulgated specifically for this situation. It was put in place in 2006 following the repeal of a residency tax timing case. So, or tax timing statute, and that's what 17952D was getting at, was saying, no, the mobilia rule does not apply here. And because there would be some argument, absent this tax timing rule, that under mobilia, that a taxpayer such as we have here in the appellant would argue that, okay, now this intangible follows me. And that's specifically when the regulation was promulgated to say, no, we set that characterization at that date. And I think when you look at, I mean, your questions, I understand your questions to really get to this idea that is this even an installment sale? Does 17952D apply? And yes, it does apply. Because if you look at, again, go back to Exhibit E in the merger agreement, it specifically talks about what happens, what was consideration for these vested options. And the consideration for these vested options was that a portion of it could be earn-out payments, which could be treated as installment payments. And that specifically takes us square into 17952D. So would 17952, going back to your hypothetical, would 17952D apply in a situation where you have a Texas resident moving to California? We wouldn't even be looking at 17952D, because that's really not the question there. It's not the question. We would be looking, this is really for California purposes.
Okay. Thank you, Ms. Swain.
Thank you.
Okay. Mr. Garrett, I'm going to refer back to Judge Lee's question about the transcript. And the Schedule D that the Fulzele's, or the taxpayers filed, treating the earnouts as long-term cap gains. And you're telling us that the events that occurred to allow them to receive those payments occurred in 2019, 2020. Why would you characterize as long-term as opposed to short-term?
I'd have to go back and check the dates. I believe it was over more than 1 year.
Even the 2020 earnout? I see the first earnout was 2019. That sort of makes sense, but the second earnout was in 2020.
I believe there was some delay in the calculation of it, I believe. I'm not exactly sure the reason for the delay, but there was some sort of delay on the first one from that measurement date until the date of payment. It was 18 months for the first earnout from the date of the transaction when the earnout was granted until the actual payment date. So it was 18 months or 18 months minus 15 days, because I think they were supposed to pay it within 15 days of confirming the amount. There are procedures under the merger agreement if there's a dispute for whether they satisfied it or and what the amount is that they could go through. And so it was an 18-month period for the first earnout and a 20-month period for the second earnout from the date of the transaction until the date that the earnout was confirmed or paid.
So you're basing the characterization of long-term using the original sale date of the company.
Correct.
Okay. And with respect to your argument on the situs, what's the intangible you're using here to say situs changed to Texas or took place in Texas?
Sure. So we believe it's not an installment sale, that's the incorrect characterization. And that situs discussion was solely for the purpose of, if it's determined to be an installment sale, then we believe it's within that business situs exception that similar to Metropolis, where that goodwill had a portion of it in New York based on the business operations and management there, that here, Mr. Fulzele's activities, the entire headquarters and commercial domicile was a Texas-based operation company, and his activities in managing it, driving it to achieve those targets was all done within Texas, and so that some portion of that or all should be attributable to a business situs in Texas. And it would be within that business situs exception of the California installment sale provision.
So you're saying Mr. Fulzele's activities is the intangible?
No, the earnout payment is the intangible. The right, that's intangible property, the right to those earnout payments.
So the right to the earnout payment is the intangible. And that right, which was given to Mr. Fulzele in 2018 as part of the merger agreement. So he got cash of $10.5 million.
Correct.
And he got this earnout payment. So that you're splitting the installment, well, splitting the transaction into two parts. One is the actual $10.5 million payout, and the second part was the earnout payment.
Correct.
And the earnout payment, you're now saying, is the intangible which acquired a Texas situs by 2020.
That's correct. It was the earnout, the right to the earnout was based on achieving certain targets in subscriptions. I can give you the actual.
Well, that's fine. I understand that, it could be based on sales, enough number of customers, number of loans, whatever the numbers are, the metrics are for the earning that money. That's neither here nor there. But I'm just trying to nail down what is the intangible that you were referring to that acquired the Texas situs, and you're telling me it's the earnout, the agreement to pay the earnout, which acquired a Texas situs by 2020.
Correct.
Okay. Thank you. No further questions? Judge Lambert, Judge Lee?
No further questions.
Okay. I'd like to thank everybody for excellent presentations. This brings the hearing in this appeal to a conclusion. The case is submitted for decision. We will endeavor to send out a decision within 100 days, and this will take us off the record. Thank you very much.